Good afternoon, I'm Bill Blain, Chief Strategist for Shard Capital here in London. Let's take a look at markets this last week of November 2018. We got some very interesting things going on, but generally markets are feeling very depressed and very negative. Why? We've seen most of the gains in the stock markets that were made earlier this year are now reversed, and we're looking negative in many stock market sectors. We're seeing spreads widening in the corporate bond markets, triggered by some downgrades and concerns about some of the largest corporate borrowers. We're seeing a continuation of expectations that next year we'll see further rises in global interest rates. We're hearing concerns from many investors that there's even the possibility of recession next year. Then, of course, we have all the ongoing doubts about potential trade war between China and the US, and potentially even the US against Germany and the rest of Europe, with German car makers being hauled into the White House for a lecture this week. And finally, of course, sitting here in London, we have Brexit. Theresa May has 2 weeks to get together a parliamentary majority to approve the deal with Europe, and if that doesn't pass, we will see continued uncertainty on sterling and the UK markets. But if we step back and try and analyse what's actually going on, it gives us some hope that there are elements and sectors of the market that are going to remain investable. And let's try and think about some of these. The first is in the bond markets. The big shock in recent weeks has been GE. Just a few years ago, GE was a AAA rated borrower. It was one of the largest issuers of commercial paper and debt in the world. After a series of accounting scandals and misstatements, it's now crashed to one notch above junk debt. If it is further downgraded into junk, most current holders of the name will be forced to sell, creating a fire sale. And that will not only damage the spread for GE, but is likely to cause contagion across all the bond markets. And then, of course, we know that in the last 3 years, GE has bought back some $26 billion of its own stock, borrowing money in the bond market to convert equity into debt. And that has made the current position of the firm more difficult and increases and forces them to repay debt by a series of asset sales. When that happens to a firm as large and as important as GE, the market immediately starts to worry about other names. And that's what creates opportunity. When we see spreads widen on fears created by one name, it's certainly worth looking to see where that puts value. At the moment, markets are extremely illiquid. Anyone trying to sell bond positions is doing so at a distressed seller price. And again, that makes it interesting for those that can go out and take risk at a time like this. What's happened to GE is going to be reflected in the stock markets as well. Since the beginning of the era of monetary experimentation, by which of course I mean quantitative easing, we've seen ultra-low interest rates enable corporates to borrow loads and loads of money from the markets. And what have they done with that cash? Most of it has been invested in stock buybacks. That means that many corporates are heavily over-levered, but it also means that the money that has been flowing into the stock markets for buybacks is no longer going to be there as we see interest rates start to climb. And that's going to continue to be a factor next year. Even though stock market prices have come back to more realistic levels, the lack of impetus and momentum from buybacks will clog the market. And that leads us to think about where will we see growth next year. And this is one of the reasons that people are thinking about emerging markets. While the US is growing strongly, here in the UK, growth has been held back by fears about Brexit. Across Europe, growth has slowed down, partly as a result of Brexit fears, I suspect, but also because of other doubts about where the European economy is going. While we have 2% maximum growth across Europe, we're seeing emerging market economies perform particularly strongly, especially with oil prices once again so low. So many people are calling the emerging markets as a source of opportunity for next year. Whatever happens, it's going to be extremely interesting to see what happens in the political space. As I mentioned, we have Brexit here in the UK. Next year, we have a whole raft of European elections to the European Parliament. It's very likely that these will result in a very strongly populist controlling interest in the European Parliament. And who knows what kinds of issues that could create, especially as the main thing we're talking about, aside from Brexit in Europe, is where is Italy going to be. This morning, Italian spreads have tightened because it looks like there may be an accommodation between Italy and the European Union. But if that doesn't happen, expect to see further ructions in Europe. Thank you very much.